All right. Good morning. This is Aaron Staufer with Elevations Credit Union. Me and my lazy colleagues, Finian and Sadie, wanted to reach out. I've been receiving a lot of calls, texts, and emails on Silicon Valley Bank. Admittedly, people are a little bit scared because they have 2008 in their head where one bank kind of failing led to a whole bunch of banks failing. So I just wanted to kind of reach out, let you know what's going on. Reasons to think that it's going to be kind of an isolated event, as well as how is Elevations Credit Union just inherently different from Silicon Valley Bank or banks as a whole. So, yeah, really, let's just get into it. A couple different things. And starting with, spoiler alert, it has no effect on Elevations Credit Union in any way, shape, or form. Zero, zilch, nada, cero. It does not impact us in any way, shape, or form. So I'm going to start and end there. Okay. Now, getting into how are we different? Well, number one is how are banks different from credit unions? Banks tend to be a lot more volatile. And they're a lot more volatile because they can raise capital simply by going to Wall Street and saying, hey, we want to start this financial institution. Will you give us money to start it up? Credit unions don't have that ability. Elevations Credit Union literally got our start when a pool of professors decided to pool their money at the University of Colorado Boulder, and they decided to start this financial institution, credit union. Elevations Credit Union. Originally University of Colorado Federal Credit Union, now Elevations Credit Union. So that's one gigantic difference. Banks are more volatile because they can just raise capital in a snap. Credit unions do not have that ability. We raise capital by serving our membership who deposits money with us, and then we can use that capital that they've deposited with us to raise additional funds in various different ways. Okay, so that's just one gigantic difference. It's the reason when post 2008, when you heard about these financial institutions failing, they were typically banks. They were not typically credit unions. Credit unions just tend to be more diversified, less exposed to one specific sector, and we weren't as impacted as other institutions were. So that's one gigantic difference. The second gigantic difference is diversification as a whole. Silicon Valley Bank specifically was serving tech startups. Tech startups. That was where their money was made. That's who they were serving. Well, there's a downside to that. When you don't have a diversified portfolio like they didn't, you're exposed to more risk, right? When one piece of the puzzle starts to crumble, everything else starts to follow suit. When you're diversified as Elevations Credit Union is, we have a very healthy mortgage business, commercial lending business, wealth management business, deposit business, certificate deposits, home equity lines of credit, auto loans. We're just more diversified as a whole. We're a little bit unique as a credit union that we do have so much diversification going for us. Diversification can compensate for a lot of things. When rates are low, when interest rates are low like they were in 2020, 2021, lenders were not making a lot of money from the deposits that were held with them, right? When you were receiving your savings account statement, it was showing basically no interest being gained. Well, that's not good for net interest income, right? That doesn't help their interest income. But what it does help is the mortgage business, the commercial lending business, the business lending business, because those rates are also low and we are lending out more money in those arenas and raising additional capital by taking care of that portfolio. So when rates are low, we're well structured. When rates are high, we're also well structured because we're receiving more money from that net interest income, less money from maybe mortgage gains where volume just tends to be down right now, right? So diversification can solve a lot of those issues that Silicon Valley Bank came across. The third big piece of this whole thing, and it also kind of gets back to diversification in a different way, is the issue that specifically affected Silicon Valley Bank. So Silicon Valley Bank, it came out that they had to sell 2.25 billion with a B worth of securities and stocks, and a lot of times at a loss in order to keep their cash flow going, keep enough capital on hand to serve their clients. When they said that, people just started withdrawing their money like crazy because they heard, oh no, they might be in for financial trouble. Everybody starts to have what they call a run, where they just start to withdraw their money, and that increases the issue. That makes the issue much worse. So why specifically did that happen? It comes down to the Fed. Okay, so the Fed wanted to cause pain. They wanted to cause pain. They wanted to cause the interest rates to rise. That's why they've been hiking rates so quickly. They wanted to do that because they wanted to slow down consumer spending. They wanted to make it more expensive for us consumers to get stuff. So your credit card rate increased, your home equity line of credit rate increased, your car loan rates increased, everything got more expensive. By causing things to get more expensive, you're more likely to save money because you're being paid more money to save it, right? And less likely to spend money. If you're less likely to spend money and more likely to save it, cost of goods is going to start to come down, right? Inflation is simply too many people chasing too few goods. They wanted to decrease the amount of people that were chasing those goods. We're going to incentivize you to save money. We're going to de-incentivize you to spend it. Therefore, please save it, don't spend it. Well, the side effect of this is, let's look at like a 10-year treasury. Okay, if you had a 10-year treasury and you had $100 million, if a bank had $100 million invested in this 10-year treasury, and they were invested at, let's say, 2%. Okay, very conservative, very safe investment. It's a 10-year treasury. It's the bank, the federal government paying you 2% on the money that you loaned them. Okay, well, if that yield goes up to 4%, now you're receiving 4% instead of 2%. That $100 million you had at 2% is actually worth less than 2%. Why? Why, if I'm guaranteed a return on investment, is 2% worth less than 2%? Well, the reason is, why would somebody buy that treasury? Why would somebody buy that security for 2% when they can just go buy their own at 4%? It actually causes that 2% investment to be worth less than 2%. So when people started to withdraw their money from Silicon Valley Bank, they had to start selling those securities, and they had to sell them at a loss. They were no longer receiving, making this number up, but they were no longer receiving the 2% that they were supposed to be receiving. They were now receiving a fraction of that. Because again, why would somebody invest their money there when they could just go on the open market and buy it for a better yield? Okay, this is when they talk about yield curves inverting. That's kind of what they're talking about. Okay, that's exactly what happened to Silicon Valley Bank. They reported, as banks do, right? Banks are beholden to their stockholders. They report regularly to their investors on a quarterly basis. Well, when they did that, they're like, we had to take a pretty significant loss here. That caused fear to kind of take hold. That caused everybody to start to withdraw their money from that institution. I don't particularly blame them. I would be nervous for my money as well. And when they did that, all of a sudden they became insolvent. They no longer had enough money on hand to take care of what they needed to take care of, to pay out people that were owed money. FDIC quickly stepped in and said, look, we are taking over Silicon Valley Bank. Give us till Monday, literally this upcoming Monday. By then, whatever insured funds you had with them, we will be able to cover. So there's a lot of things that kind of uniquely happened here. There's a lot of reason to think that this isn't going to be 2008 again. Silicon Valley Bank was very unique. They were exposed to one specific sector. They were exposed to one specific industry, tech startups. The only other institutions you've heard about in whispers about, oh, there might be an issue here is cryptocurrency. They're also exposed to one specific sector. If you're a bank or a credit union that has a diversified portfolio, that isn't insolvent and has a lot of capital on hand, you're going to be fine, okay? Because when one sector starts to fail, the other sector kind of picks up the slack. So that's kind of what we're looking at. That's the reason why I began here. I'll end here. There's a lot of reason to think that Elevation's credit union is not going to be impacted. I can assure you that. We just have a very well diversified portfolio, and we're not at the risk. In addition, since the housing collapse 2008 happened, lenders have been required to do stress testing where they say, hey, look, what if there was high rates for 20 years? What if real estate values decreased 21%? What if commercial business decreased by X percent? How would your institution stand? And every single time we've been through a stress test, we've aced it. So I've got zero concerns, literally none. We have such a well-diversified portfolio that there's no concerns to be had. Silicon Valley Bank was very unique. Everything I've been reading says that there's a lot of reasons to think this is going to be more of an isolated event than anything else. It wouldn't surprise me at all if there's another institution or two that are affected, but I think when you do hear about those in the news, what you're going to find out is they were also exposed to one specific sector versus another, and that they had some underlying risk to begin with, which we do not have. So that's that. More details than you probably want to know. A little bit into the weeds at the end there. I apologize, but I do appreciate you. If you do have any other questions for me, let me know. And yeah, hope you're doing well on this beautiful weekend. Thank you so much. Bye.